Amortization and Tax
by Vivian Ha
and Harvinder Trahan.
First, let's talk about CCRA, which stands for Canada Customs and Revenue Agency. The CCRA sets tax laws for the Government of Canada, and they make sure everyone follows them. They also let companies deduct their amortization expense when calculating their taxable income. Today, the agency has split into two groups, so CCRA is now known as CRA.
The method that the CRA requires companies to use is the single declining balance method. This is so that companies do not increase their expenses to lower their taxes with a different amortization method.
Rules to follow when calculating taxable income.
Number 1. Always use the single declining balance method.
Number 2. Use CCA rates.
We'll discuss what these are later on in the video. Number 3. Only half of the CCA rate is calculated for the year the asset is gained. This is called the 50% rule.
CCA stands for Capital Cost Allowance. It is the highest rate you can use on your capital assets when claiming income tax. The CCA categorizes capital assets under classes and gives each class a rate that a company must use.
Okay, so over here you can see we have the chart for the 2013-2014 CCA class and rates. Thinking of an example, let's take automobile. Because it is classified under class 10, the rate would be 30%.
How to calculate amortization for income tax. So the formula is net book value times CCA rate.
And we will make sure to do a question in class to help you better understand. Is there an alternate way of calculating it?
The answer to that is no.
Does this method produce a stable or unstable, increasing or decreasing amortization expense over the asset's useful life?
This method produces a stable, decreasing amortization expense because every year the net book value of the asset,
which once again is the undepreciated cost of the asset minus depreciation,
is multiplied by the CCA rate.
What do you do if the asset is purchased throughout the year?
If the asset is purchased throughout the year, you would use the 50% rule, where you would calculate half of the CCA rate.
Okay, referring back to the automobile example, the CCA rate would normally be 30%. However, if you were to buy the automobile in the middle of the year, when calculating the amortization expense, you would use half of the CCA rate. So for that first year that you have the automobile, the rate is 15%.
By now you should know
what the CRA is,
what CCA and CCA rates are,
what the 50% rule is,
and how to calculate amortization for income tax.
That concludes our video.
We will discuss this more and work on some questions in class.
Bye from Harvinder.
And bye from Vivian.